So you want to own an AI data center. Everyone tells you Nvidia sells the shovels in this gold rush. What nobody tells you? The shovels dissolve. The building you'd own lasts 30 years. The machines inside it, the ones earning every single dollar, lose most of their value in about 4. That's the entire business. And almost nobody prices it honestly because on paper it's beautiful. Microsoft, Meta and OpenAI lining up to rent computing power from you 24 hours a day. By the end of this video, you'll know what it costs to get in, how the money actually flows, what a realistic profit looks like with the math, and the story of the company that invented this business model. Then watch its biggest customer become its biggest competitor. First, the price of entry. The building itself. Land, shell, power, cooling runs $15 to $20 million per megawatt for an AI-grade facility, per Goldman Sachs. That's before a single chip. Fill it, and the number explodes. One current generation rack, 72 GPUs drawing about 120 kilowatts, costs an estimated $2 to $3 million. All in, analysts put an AI data center at $35 to $60 million per megawatt, and roughly 60% of that is chips. Traditional data centers were the exact inverse. The building was the asset. Now the building is the wrapper, and nobody pays cash. The signature move is borrowing billions against the GPUs themselves. In 2023, lenders wanted around 15% for that loan. You'll meet the company that invented it in a minute. By March 2026, GPU-backed debt was rated investment grade at roughly 6%. Wall Street went from exotic gamble to safe as houses in 30 months. So how does the money come in? One line, GPUs times hourly rate times utilization. That's the whole machine. Run it. 1 megawatt of compute power fits about 8 racks, call it 576 GPUs. Current generation chips rent for around $6 an hour on average. Big clouds charge more, independence less. Assume 70% utilization. And that is an assumption because nobody publishes real utilization numbers, and you're grossing roughly $21 million a year per megawatt against about $40 million to build it. Gross payback in 2 to 3 years. That's why everyone on earth is building this. Now the danger. The previous generation of chips rented for $8 an hour in early 2024. Today's median about $3.15, down more than 60% in 30 months, while more than 300 new GPU clouds flooded the market. To be fair, it's not a one-way crash. One-year contract rates bounced 40% off their late 2025 low. But your debt payment doesn't care which way rates go. It's fixed. Which brings us to the question that decides whether you make any money at all. How long does the machine you just borrowed, $40 million against actually live? Google and Microsoft depreciate their servers over 6 years. Meta says 5.5. Amazon looked at the same market and went the other way, shortening some of theirs to 5, citing the pace of AI hardware. When the richest companies on the planet can't agree how fast the same asset dies, that's not an accounting detail, that's the whole game. Michael Burry, the investor from The Big Short, says the real number is 2 to 3 years, and that stretching it means the industry is understating depreciation by $176 billion through 2028. Money that flows straight into inflated earnings. His comparison wasn't Enron, it was Cisco, 1999. The rebuttal is real. Chips from 2020 are still out there earning money on inference, but the used market has voted. Trackers show second-hand H100s selling as much as 85% below their peak. If Burry is right, your collateral is worth scrap before your loan is half paid. Now, watch one company live this math in public. CoreWeave started out mining Ethereum. When crypto cooled, they pointed their GPUs at AI and invented that loan from earlier. Billions borrowed against the chips themselves. starting at 15%. March 2025, they went public at around a $35 billion valuation. Today, their backlog is $99 billion. 21 billion committed by Meta, 22 by OpenAI. Locked in revenue most landlords can only dream about. And yet, first quarter of 2026, $2 billion of revenue, up 111%, and a $740 million net loss with interest costs doubling, cash margins around 60% last year, and still losing money because depreciation and interest eat every bit of it. Then July 2026 delivered the plot twist. Meta, the $21 billion customer, launched Meta Compute, selling its own spare GPU capacity. The customer became a competitor. CoreWeave's stock fell by roughly a third in 3 weeks. In this business, your biggest customers are the only people rich enough to replace you. So let's run your megawatt honestly. 21 million a year coming in at today's rates. Take out about $1 million to operate it. Power, cooling, staff per epoch's cost model. You borrowed 30 of the 40 million at 6%. That's roughly 2 million in interest. Now depreciate the chips. $24 million of them. On Google's 6-year schedule, that's 4 million a year. You clear something like $13 million every year. A spectacular business. Now run Burry's version. Chips die in 3 years, 8 million a year, not 4. And say, rental rates repeat what the last generation actually did. Get today's contract rate to 35. Your revenue drops to about 8 million. 8 million in, 11 million out. You're underwater. Same building, same machines. Every number in that second scenario has already happened once. The only question is whether it happens to yours. So who's actually getting rich here? Follow the margins. Nvidia. 71% gross margin selling the chips. One electrical contractor alone is sitting on a record $12 billion backlog, building the shells. Utilities are signing 20-year power contracts with trillion-dollar tenants. Equinix, the landlord, are at 49% margins. Everyone selling to the data center owner is printing money. The owner is the one holding the depreciation, and the market can't even decide if there's too much of this or not enough. Communities blocked $130 billion of projects in the first 3 months of this year, while vacancy in Northern Virginia sits at 0.3%, the lowest ever recorded, with 80% of construction in the top markets already pre-leased. Which side of that paradox you land on depends on whether you own a finished building with power or a press release. So the next time someone calls AI data centers the real estate deal of the century, remember what you're actually buying. A 30-year building wrapped around a 4-year machine. The rent is spectacular. The rooms expire. This is the economics of XAI edition. Next episode. What one single day of running ChatGPT actually costs for the world's most expensive free product.